down nearly 94% off its high. Is it finally time to buy Upstart stock? The AI lending company is an interesting one to consider given the rising effectiveness of artificial intelligence. It's one of the few AI related stocks that's not absolutely soaring. Does that mean it's an opportunity for investors interested in capitalizing on the AI investing trend? Well, this video will analyze Upstart stock and answer that question of is it a buy on this huge dip here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I'm going to compare Upstart and how it's been doing over the recent few quarters, and I'm going to look at over longer term recent few years how it's been doing, and the longer term looking forward what its prospects are. But let's start with the recent quarter and the recently completed year. Total revenue came in at 140 million, which was down 4% from the same quarter the prior year. It originated 129,664 loans, which was down 19% year over year. And its net income of 42.4 million negative was a little bit better than the negative 55.3 million it delivered in the same quarter the prior year. Now, while these numbers don't look great, they are better than the full year numbers in 2023, which I'll share with you in a little bit, which suggests that the company is improving. While 2023 was an awful year for Upstart, it was improving. It was improving. So for the full year, total revenue was 514 million, which was down 39% year over year. So the year over year decrease in the most recent quarter was much smaller than for the most recent completed year. The 437,000 loans was down 59% year over year. Again, that was worse than the most recent quarter, which was down less than that. And finally, net income worsened for the year. It was down 240 million negative compared to negative 109 million the prior year. So more than double the net loss on the bottom line for the full year. Whereas in the most recent quarter, the net income loss in the most recent quarter was smaller than the net income loss in the most recent quarter in 2022. So while it was an awful year for Upstart, it was getting better. Things were improving, and you can see that in its latest quarterly results. Still, by no stretch of the imagination can you say it was a good year for Upstart. Now, one of the reasons for this poor outcome was the rising interest rates. When interest rates started to rise, lenders on the Upstart platform started to fear there would be a recession, there would be slowdowns in economic activity, which leads to job losses, which leads to some people not paying back their debt. And for that reason, lenders started to pull back and say, we don't want to make loans on the Upstart platform, or we want to make significantly fewer loans on the Upstart platform, especially because its AI lending model, while it's innovative, it's yet unproven. It hasn't been through the economic cycles that traditional lending models have been through, and so lenders can feel more confident relying on the data from those models, whereas the AI model from Upstart, even though Upstart management says it's going to be better than traditional lending models, that hasn't yet been proven. And lenders wait for things to be proven before they start to rely on them, right? So they're more prudent investors than most folks consider equity stock investors to be. Equity stock investors are willing to take more chances. They're willing to take risks. They're willing to take a shot at that unproven growth company that's losing money on the bottom line. Lenders are not that risk taking. They're more risk averse, and you see that in several categories, including in the lending activity on the Upstart platform. Now, longer term, Upstart has shown that its business at a larger scale can be effective. So during the earlier days of the pandemic, when interest rates were significantly lower and economic activity was larger, lending on the platform was more diverse and more abundant, and revenue soared close to $1 billion annually for Upstart. But ever since interest rates started to rise, you saw revenue collapse nearly half of where it was at its peak. Additionally, when revenues were much higher, Upstart demonstrated that the company can be profitable on the bottom line. You see here's the zero line here. And for several quarters in a trailing 12-month period, for all of 2021 and for part of 2022, Upstart was profitable on the bottom line. So it has shown when revenue is roughly twice where it is in the most recently completed year, the company can generate profits on the bottom line. So that part it has proven to investors. But since then, since generating 150 in trailing 12-month revenue million, it's collapsed down near 300 million, getting a little bit better at negative losses of 240 million in the most recently completed year. Now, Upstart, I mentioned that its stock price has fallen by over 93% since its highs, and Upstart management has taken that opportunity to buy back some shares. Upstart management thinks its stock is now significantly undervalued, and so it bought back some shares. I have here a chart of its shares outstanding, and you could see it since the stock price collapsed in 2022. You could see shares outstanding decreased as management bought back shares in the company. Now, when or if it becomes profitable, the earnings per share could be higher now because there are fewer shares outstanding. Looking forward, analysts on Wall Street that are following Upstart stock, they think its earnings per share are going to grow by 30% per year for the next 5 years. Now, while its earnings per share are negative in 2023 and are expected to be negative again in 2024, 2025, analysts on Wall Street expect it will be positive. In fact, analysts on Wall Street expect its earnings per share to be negative 76 cents in 2024 and then jump to 16 cents positive for 2025. So analysts on Wall Street expect Upstart to return to profitability in 2025. Now, part of that expectation is that interest rates are expected to move lower. The central bank in the United States, the Federal Reserve, has indicated that it is going to cut interest rates 3 times this year, according to estimates submitted by its participants. Although I started the year with estimating 3 interest rate cuts for the year, I've now lowered my expectations to just 2 interest rate cuts for this year. Still, if the cuts don't happen this year, it's expected that they will just be pushed back into 2025 when there will be more interest rate cuts. Why are interest rates expected to be moving lower? Because the neutral interest rate, the interest rate at which the Federal Reserve estimates that the economy is neither being stimulated or suppressed with its interest rates, is somewhere between 3.5%, maybe 2.75%. So at the current rates of above 5%, the Federal Reserve is purposefully suppressing economic activity to bring down inflation. And so it's expected that once the Federal Reserve gets inflation to a level they feel comfortable with, they are going to decrease interest rates to a more neutral level around between 2.75 to 3.5%. Somewhere in that range. Nobody really knows what the neutral interest rate is. It's estimated around that level. So the interest rates will gravitate towards that level longer term. That's why the expectations are that interest rates will move lower from the currently above 5% level. So finally, currently, Upstart is trading at a forward price to sales of 2.721. Not the lowest it has traded for according to this valuation, but pretty close to the lowest it has traded for according to this valuation. Still, even though the stock is down so much and it's trading near the lowest valuation it has been at, I would not recommend the stock as a buy right now. I would still wait for more information from this company. I would still wait for more progress towards profitability, for these losses in year over year in lending, in revenue, in profitability. I want to see continued improvement. I want to see steps forward towards interest rate cuts, because the economic activity has been a lot hotter than expected in 2024. Maybe I'll have to revise my expectations again for interest rate cuts. And maybe the Federal Reserve says, you know what? We're not going to cut interest rates because inflation continues to remain too high. maybe we need to increase interest rates. And so that could be really damaging to Upstart and its prospects. It could be really damaging. So this is more of a wait and see. It's an interesting AI company that I would just put on my watch list and keep an eye on, but I wouldn't rate it as a buy right now. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.